both Trump and the chairman, I would give a letter grade F to. If they were in my class, they'd both get Fs. Powell has a terrible record. He's had us on a roller coaster. Money supply goes up, inflation goes up. Then money supply contracts and inflation starts going down. He, like Trump, he thinks looking at the interest rate is an indicator of monetary policy. Changes in the money supply indicate what's going on with monetary policy.
Inflation data came out this week. CPI, headline CPI is at 2.7%. It picked up a little bit in June. It's up from the previous month. It's the first time it's been up since the beginning of the year. It's been trending down all year, so we'll talk about that. PPI data came out on Wednesday. It's at 2.3% versus a 2.5% estimate. And core CPI is at 2.9%. The month-over-month change was more or less in line with analyst estimates. So what's going on? We'll talk about this. We'll talk about Donald Trump's pressure on the Federal Reserve with our next guest, Steve Hanke, professor of economics, applied economics at Johns Hopkins University. Welcome back, Steve.
Great to be with you, David.
Thank you, Professor, as always, for joining us. Yeah, let's talk about inflation. First uptick in months. Every headline I've read so far on mainstream news has been calling this a result of the tariffs. CNBC, for example, stated earlier this week, consumer prices in June rose as President Donald Trump's tariffs began to slowly work their way through the economy. Is that true?
There might be an element of truth in that, but do remember my Hanke's 95% rule. 95% of what you read in the press is either wrong or irrelevant. Let's go through. You mentioned the CPI. Well, the CPI did jump up from 2.4% to 2.7%. As you say, the first jump we've had for quite some time. And the interpretation, everyone's interpretation was, well, this is Trump's tariffs. So that's one number. Now, the second number is the producer price index. And the producer price index stayed constant at 2.3% year over year. And in fact, the 50 analysts that report to Bloomberg on forecasting the PPI, they were all wrong. They all said it was going to go up. Well, it flatlined. It didn't do anything. And they said it was going to go up primarily because of tariffs. So if you look at those two numbers, we really get kind of a mixed picture going on. You get a lot of, you basically have a lot of noise. You got the CPI going up, the PPI flatlined, and I would also add that before this, to make things even more confusing, is that the spin meister in the White House is Kevin Hassett. He's the top economic advisor of Trump. And this past Sunday on CNBC, he said that the CPI had reached its lowest level in a decade, which is blatantly false. It's not true. That's an untrue statement. But there are a lot of untrue statements that come from the White House or from Washington, D.C. in that regard. So there you have the picture. You got a lot of spin going on and interpretations and so forth. My take is the following. We are still in a downward trajectory for inflation, and the reason for that is that inflation is always and everywhere a monetary phenomenon. So you have to look at what was going on a couple of years ago with the money supply to get some idea of what's going to be happening with inflation today or tomorrow. And since the money supply 2.5 years ago was actually contracting, it would indicate that we'd stay on this downward trajectory, and that would be the major force moving the overall price index. However, we do have to put a caveat in here, and that is that some of these tariffs, which is nothing more than a one-time tax, by the way, eventually, depending on how they're imposed, at what level they're imposed, what countries, We still don't even know that. None of it's finalized yet. And the reason for that is that Trump has no tariff plan. He doesn't know what the word plan means. The thing changes from hour to hour. But as soon as the dust settles, some of that will come in and be reflected in relative price changes on those items that are taxed with the tariff. And we could see some temporary ticks up in the price index. So that it is possible and it's probable. But these are one-time blips in the price index, and then it starts going in the direction dictated by changes in the monetary policy. It's like a depreciation. If you have a very open economy, for example, like the United Kingdom, it's very open. They do a lot of trading. Trade is a big chunk of GDP in the United Kingdom. So if you have a big depreciation in the pound sterling, that will cause a one-time blip up in inflation. And then things start moving in whatever direction is being dictated by monetary policy. So it's all a matter of, shall we say, nuance and so forth, rather than spin.
So would you say, Professor, that the PPI is a better indicator of long-term price trends than the CPI, which is a little more volatile?
Yes, in this case, because it's picking up, commodities and inputs, and those commodities and inputs are going to be directly affected by the tariffs, for example. So if you want to look at the effect of a change in the exchange rate on price indices, PPI is better than CPI. Okay. And I think that's also true with these tariffs, because tariffs in a way are pretty close to changes in exchange rates and how they work through the system.
Before we continue, let me tell you about protecting your most important asset, your personal information. Now, your personal information is likely out there on dozens of data broker sites you've never even heard of. These sites collect and sell your name, address, phone number, and more without your permission. That's why I use today's sponsor, Delete Me. It's a service that finds your personal data across the internet and gets it removed. And it doesn't just do it once, it does it continuously and monitors it and removes it throughout the year. All you have to do is submit your information, and within a week, you get a privacy report showing where your data was found and what's been removed. The whole process is simple, and it runs in the background so you don't have to think about it. Go to joindeleteme.com/DavidLynn and use the promo code DavidLynn at checkout, or scan the QR code here on screen to get 20% off on all U.S. plans. Join Delete Me now and take control of your privacy today.
Well, let's just take a look at this visual that I like to show from the BLS. Shelter remains a major, if not the biggest component of the CPI. It's still at 3.8%, although the rate of change, the inflation rate of shelter has been trending down, so that may have been a contributor. Food at home jumped up the most. Food at home. Eggs, for example, I was reading in the CPI breakdown, eggs up about 27% year over year in the last month. Coffee up 13%. Food away from home, so restaurants, also up a little bit, although that has less to do with groceries and more with restaurant pricing. So, let's just take a look at what Americans care about: food and shelter. Food ticked up, shelter's still up, and energy actually is went up a little bit as well. May saw a decline in energy prices, but the last month, as you know, oil prices went up a little bit, mainly due to the spike in June. Anyway, by
the way, David, back to your question, one thing, the producer price index, it's all focused on what we call tradeables, things that are traded in international trade, and those things are affected by what? Tariffs. Tariffs affect tradeables, and changes in exchange rates affect tradeables. The non-tradeables, like housing, you can't trade land in the United States for land in Taiwan or something like that, or Canada, or whatever have you. And you can't trade a house in Canada for a house in the United States unless it's, of course, that would exclude mobile homes.
Yes.
I guess you can trade those, but at any rate, you get the point. That's why keeping your eye on the PPI will be important going forward. More important than is normally the case, because we'll have an intervention, mainly the tariffs, that are actually working their way and affecting things on the tradable front.
Well, we're speaking today on the 16th of July. As of the 1st of August, new tariffs will be implemented worldwide, right? There's a 35% flat tariff on Canadian imports, for example. 2 weeks ago, Trump implemented new tariffs on Korea and Japan. Now Trump is threatening 100% tariffs on Russia if they don't come to a deal with Ukraine in the next 50 days or so. By the way, is he serious about that? I mean, does Putin care that there's going to be a 100% tariff?
A couple of comments on that. The one thing that is important to realize is that there's more to tariffs and the threat of tariffs than meets the eye, because they basically are a weapon. They're like sanctions. They're the same thing as sanctions. Yeah. So if you put a tariff on Canada, what's that mean? You're launching an attack on Canada or whatever the country happens to be. So, and especially like in the Canadian case, just for example, I would say Trump is running a master class on how to make enemies. He's making enemies all over the place, including Canada. I mean, the snowbirds are mad as hell at the United States. They stopped coming to the United States. The touristic activity coming from Canada is dwindled down to virtually nothing. Because why? Because they're mad at Trump and the tariffs. It's like shooting a bazooka into Canada. Now let's go to Russia. Russia, the 100% tariffs would be secondary tariffs, or like secondary sanctions. If India and China keep buying Russian oil, which they buy a lot of, by the way, they would be faced with 100% tariffs for anything that they wanted to export from India or China to the United States. Now, number one, does this make much sense? What the hell does this have to do with Russia? It's a secondary thing, a second order thing. So what we're in a war with Russia, and don't kid yourself. This is Trump's war now. It was Biden's war. Now it's Trump's war. He's continuing to send money to Ukraine, send weapons to Ukraine. So the U.S. is in a war with Russia. Now he wants to threaten a potential war with China and India. That's what these secondary tariffs are. They're like secondary sanctions. So that's why I say Trump has turned into a master class on how to make enemies. Bad news from the U.S. point of view. The chickens will come home to roost eventually. Where the U.S. will have so damn many enemies by the end of this thing, you won't be able to shake a stick at them.
Okay, so I think just going back to the CPI breakdown, food, energy, shelter, I think those are the main things that people care about, and medical costs. Although the medical costs have not been going up, that's not really a tariff-dependent issue. What is your outlook? I know we've talked about monetary policy and the overall monetary base situation, but did you have any outlook on specific items like food away from home, food at home, groceries, for example, shelter prices? Do you have any insight on energy prices?
Let's keep talking in the framework that we've been talking, so it doesn't get confusing. Let's talk about tradeables, those things that are largely affected and have come up on the producer price index, and then the overall consumer price index, which includes everything. It includes the raw material inputs, the intermediate project production, and other items, including a lot of non-tradeables. So I think I would anticipate that the non-tradeables would keep coming down under the pressure of this anemic growth in the money supply. And when I say anemic, it hasn't moved much in total for about 2.5 years, and the rate of growth in the money supply now is only 4.5%, which is way below Hanke's golden growth rate of 6.3%, a rate consistent with the 2% inflation target. So I think the non-tradeables will actually be under pressure to be coming down. The tradeables it's another story. It depends exactly on how these tariffs are imposed and at what levels are imposed. But that's what we want to keep our eye on. As more of these tariffs get locked in and we know more about them, we'll be able to see the effect of that coming through the producer price index, because those are all tradable goods and services, and they'll be all affected by tariffs in one way or another.
Okay, so what you're saying is, correct me if I'm wrong, the monetary policy aspect, the money supply, the lag induced by the money supply, that will take some time to feed into lower inflation, but the more immediate consequence on prices will come from tariffs. In other words, Americans may still see price increases before prices stabilize.
That's correct, and those tariff-induced price increases are in a way, the effect of them is temporary. It'll go away. It could potentially increase the level, and that level would be higher, obviously, than before the tariffs. But then the trajectory of the thing going forward will be affected by what's been going on with the money supply. So it is possible to get a price index ratcheting up, but it would ratchet up and then take a path that's determined by what's been going on with the money supply. So you kind of have two things going on at once, which, by the way, will confuse everybody, especially the journalist will be completely confused by this, because they'll see the ratchet up and they'll claim that inflation is back and inflation is going to get worse. No, we had a one-time jump, but then inflation starts on the old trajectory again that it was on before the jump up.
Right after the inflation report came out, Trump called the Federal Reserve to lower rates by 300 basis points. Now, he said this before. This is not the first time he said it. He's just doubling down. Consumer prices low. Bring down the Fed rate now, Trump said in the post on Truth Social. Fed should cut rates by 3 points. Very low inflation, $1 trillion a year would be saved. What does he mean $1 trillion a year would be saved?
Well, he's making it. His people have given him bum information, because he looks at the federal funds rate, and he wants the federal funds rate to be reduced by 3 percentage points, okay? And he looks at the difference between the federal funds rate now and with the 3 percentage point reduction. And he multiplies that times the financing required by the federal government to service the debt. The problem is the government does not borrow at the federal funds rate. That's essentially irrelevant. It's a spurious kind of thing to be making a calculation like that. The duration of the average duration of Treasury securities out there now in the market is about 6.5 or 7 years. It's not a spot rate like the federal funds rate. The federal funds rate's a spot rate. It's today's rate. But the government doesn't borrow at that rate. So they've made the wrong calculation. And like many things coming from the White House, it's just rubbish. It's irrelevant.
Okay, but should the Fed follow these, I guess, I don't even know what you call them, instructions, wish list for Santa. I'm not sure what you call this, but should they lower rates by 300 basis points?
Let's talk a little bit about Trump and Chairman Powell.
Yeah.
Neither one of them have a good grip on monetary policy at all. And let me first start with Powell. You and I have gone over this over and over and over again ever since COVID started. Powell has a terrible record as a governor, a chairman, of the Fed. And he's had us on a roller coaster. Money supply goes up, inflation goes up. Then money supply contracts and inflation starts going down, up, down, all over the place. And the reason for that is that he, like Trump, he thinks looking at the interest rate is an indicator of monetary policy. No, interest rates are not an indicator of monetary policy. Changes in the money supply indicate what's going on with monetary policy. So he's got it all wrong, and he's testified on this over and over again. He does not think the money supply has a bearing on economic activity that's reliable, and he rejects, and all the staff of the Economist at the Fed reject the quantity theory of money. The whole idea of the book Matt Sakurki and I just wrote, Making Money Work, which by the way, came out and was released May 6th, is to put the quantity theory of money back in the picture. So that's where we are with the chairman. Now, the president has essentially the same view. The president thinks monetary policy is all about interest rates. He never talks about the money supply. He's always talking about interest rates, always irrelevant. So both Trump and the chairman, I would give a letter grade F to. If they were in my class, they'd both get Fs.
Here's the thing: if inflation has more to do with the money supply, and the money supply has nothing to do directly with the interest rate here in this case, then why not just cut the Fed funds rate by 300 basis points? Inflation may not come back right away because the money supply is still growing at below Hanke's golden growth rate of 6%. And then you get economic growth and no inflation. Isn't that the best of both worlds?
Well, no, it isn't, because number one, if you change that Fed funds rate, you would do a number of things. They like to talk about anchoring inflation expectations. Now, most people, by the way, don't understand what's going on. And that, when I say most, I'm talking about people on Wall Street. People on Wall Street think exactly like Trump, and they think exactly like the chairman, Powell, in principle. No, that is a focus on the interest rates. So if the interest rate would be dropped by 3 basis points, 3 percentage points, not basis points, you would have an unanchoring of inflation expectations. Everyone would start thinking that inflation was going to be going up because they don't pay any attention to the money supply, but their expectations would change. And so that's one thing that changes, and that would not be helpful, by the way. The other thing that would change is the dollar. The dollar would get weaker, and the dollar did get weaker, by the way. Just an hour or so ago, the president drafted up a letter and made it public that he wants to fire Powell. He wants to get rid of Powell. This is nothing new. He's been beating this drum now pretty hard for several weeks. I would say in this case, although both personalities get a letter grade F from Hanke, I hope Powell stays the course. And the reason for that is that this again would throw tremendous regime uncertainty into the picture and be very destabilizing, because the next person going in, they're going to be a hack of President Trump. There'll be someone that Trump thinks he can dictate monetary policy to. So you'd basically have Trump running monetary policy, which is you need that like a hole in the head.
Well, but okay, should the Fed raise rates? And this is just I'm going somewhere with this. Like I stated earlier in the interview, food costs are going up. Energy still remains high. Asset prices remain high. Housing prices remain stubbornly high. Even though the Fed funds rate is between 4.25 to 4.5%, the CPI as a whole looks to be stabilizing. But these particular things that people care about the most are still going up, and so it's not working. A lot of people would say.
Well, yeah. What listening to you is interesting because your mindset is exactly like Trump and Powell and most of Wall Street. You want to keep coming back and focusing on the Fed funds rate, and I'm saying that's not. It might be a second or third order condition, but the first order condition is what's going on with the money supply. So how do you deal with that? The first thing to do is to stop quantitative tightening. Stop shrinking the Fed's balance sheet. That would be the first thing to do. And the second thing to do would be to announce that all of a sudden Paul's got religion. He's embracing the quantity theory of money, and he's decided he's following Sakurki and Hanke's book, Making Money Work. He's adopted the quantity theory of money, and he realizes that we have to get the money supply growing again. And the best way to do that is to stop tightening. He's tightening now with the quantitative tightening.
What happens immediately after you stop tightening? By you, I mean the Fed.
Well, what happens is the money supply starts growing at a more rapid rate, and with a lag, then that works into the economy. Remember, with a lag, it does. It's not like walking in a room and turning a switch on. These things take time to work themselves through the economy. I mean, the inflation we're witnessing today is a result of what happened to the money supply a couple of years ago. And of course, that's another reason people get confused. They're data dependent, and they look at the data today and they try to interpret, well, what's that mean? You know, they got their finger in the wind. What's that mean? How do I interpret that? They don't realize that that's a symptom of and something that was caused by what happened to the money supply a couple of years ago, because they never look at the money supply. They ever. They don't look at it today, or they don't look at and think about what was going on with it 2 years ago. It's just erased. It's not on their radar screen. So all the interpretation of everything is just wrong.
Okay, so bottom line, you still think that inflation is not going to be a huge problem for the long term, given that the money supply is still not growing above 6%. So we shouldn't be too worried about inflation going double digits right now, right?
Let's define the long term as like 6 to 9 months.
Yeah, let's yeah, sure.
You know, right. As Keynes said, we're all dead in the long run.
No, yeah, fair enough. So in the next year, we shouldn't be concerned about double-digit inflation or not double-digit inflation, maybe high single-digit inflation coming back. You know, people have painful memories of 2020 and 2021. So
that's right. But that was all due to the fact that the money supply got goosed and was growing at one point, David, over 18% year over year. Now it's growing at 4.5%. At the peak, it was growing in 2021 at a little over 18% year over year, and that's why we had inflation then. I know, in looking around in world history, I know of no significant inflation, and that means an inflation of over 4% per year, lasting for 2 years or more, that wasn't preceded by a significant increase in the money supply. End of story.
This is, can we spend a couple minutes and talk about some of the themes from your recent book before we jump off?
Yeah.
My producer and I skimmed a little bit. I didn't read the whole thing, but some passages stood out. It's
Shame
called
on you.
I will get to finish reading it, all of it. I promise at some point.
Okay. Well, read it.
In the next,
look. When you go to that wedding you're going to in Hong Kong, it's
yeah.
a long flight. Take the damn
Bring the
book with you
yeah.
and read the thing.
Yeah. I'll finish it in the long term. I'm kidding. All right, making money work. How to rewrite the rules of our financial system. That's what it's called. The book opens in this way. Let me just share my screen here. Yes. The global finance, well, this is the introduction, and then it says, money has disappeared from economic thinking, absorbed into interest and prices. Money has disappeared from economic thinking. Okay, that's a bold statement. How did the economics profession manage to lose sight of something as fundamental as economic thinking? Yeah.
So that's a key. That's a pretty good sentence. I like that very much. And for the last 30 years, we've had economic theorizing at the macroeconomic level that's focused on what they call post-Keynesian models. Not Keynes, because actually, believe it or not, Keynes paid a lot of attention to money, especially in his 2-volume treatise. The treatise, this was before he wrote the General Equilibrium. The treatise was all money. So that was Keynes, and even in the General Equilibrium. So the Keynesians, of course, trashed monetarism and money, and it kind of slid out of the picture, and they just focused on fiscal policy, not monetary policy, and that was a domain of macroeconomics. And then we had Friedman in the 70s brought monetarism back in kind of a counter-revolution. And then for the last 30 years, we've had another counter-revolution, and that is post-Keynesian economics. And the post-Keynesian economic models, those macroeconomic models, David, they don't include money. Money is not, there's no aggregate measure for money, like M1, M2, M3, M4, whatever M you want. It's just not in the model. So that is one reason, by the way, that Powell, who's not an economist, he is advised by what? His research staff at the Fed. They have a huge research staff, and the Fed system, I think they've got around, between 750 and 800 economists, but they're almost all of them are reading from the same song sheet, and that's these post-Keynesian models. So that's how it disappeared at kind of a theoretical level. It disappeared from central banks as a political thing, because central banks are supposed to be in charge of monetary policy and the supply of money. And if something like inflation raises its ugly head, they don't want to be blamed for it. They don't want to be connected with any changes in the money supply that might have affected inflation. So they want it out. In other words, they want inflation always explained by some non-monetary factor. So to keep it simple, that's why politically central bankers like these post-Keynesian models in a way, because post-Keynesian models don't include money. And if you don't include money as a cause of inflation, that means that the thing that the central banks control with monetary policy is out of the picture. So you can't blame the central bankers for anything they're responsible for. It's always the supply chain, the oil prices, the this, that, and the other thing. That's what causes inflation, not changes in money supply. So you've got two things going on that are kind of complementary in a way.
Just a few sentences from this chapter. Neutral money policy. The money supply must be created and continually renewed by the banking system. The money supply must be created and continually renewed by the banking system, the government and non-bank financial institutions. So first of all, what do you mean by that? And second, It says here, the supply of money will privilege incomes and prices in certain sectors at the expense of others. Contrary to the received economic wisdom, money is not neutral in the short run or the long run. I'm presuming you mean this is not what the Fed is currently engaged in?
Yeah, the Fed pays no attention to that at all. They probably don't even realize it. But if you inject money into the economy, it potentially Matt Sakurki and I argue that one objective, and this is a big contribution in our book, one objective of monetary policy shouldn't be just stable prices, but it should be neutrality. Now, the money supply should affect as much as possible individuals and sectors of the economy in a neutral way, not in a distorted way. Now let me give you a very concrete example, David, that drives this home. Because what I just said is kind of theoretical, stuff for the high priest of economic theory and so forth. Let's talk about it in terms that your viewers can understand. And that is, when the COVID hit in February of 2020, the Fed goosed the money supply. Now, that goosing was not neutral. It affected different classes of people in very different ways. And one thing that happened, it made the asset prices go up. Once the money supply was increased and goosed, asset prices dramatically went up. Real estate prices went up. Yes. The stock market went up. Yes. Land prices went up, and all of this. Now, who owns the assets? Well, rich people own assets. Poor people, even middle-class people, don't own many of the assets. So you had a non-neutral impact on the distribution of income. People who were billionaires made out like bandits. When in January of 2020, right before COVID, the wealth of billionaires in the United States amounted to 14.1% of GDP. Uh-huh. Today, that percentage of wealth of the billionaires as a percent of GDP is 21.7%. So by being non-neutral, the Fed has created a huge income inequality in America. You don't want monetary policy doing that. You want it to be neutral. You want to design things so they're neutral. Now, obviously, one way to do that is to have a fairly steady and stable growth rate in the money supply. Hanke's golden growth rate is 6.3%, using M2 as a measure, would be consistent with an inflation target of 2%, and it would be a hell of a lot more neutral than what Powell was engaged in. That's another reason, by the way, I'd give him an F, for Powell.
Do you subscribe to the theory that perhaps if the rich get richer through asset price inflation, the economy overall could be safe? Let's just go back to COVID, for example. The economy was on the brink of collapsing, well, in many ways it did. And so the Fed felt that they had to step in and prevent a total system collapse by injecting a lot of liquidity. Now, like you said, different people were affected in different ways. The rich got richer, while the poor arguably got poorer because of price inflation of consumer prices. But in any case, if the rich get richer, Professor, don't they create jobs? Don't they stimulate the economy?
Yeah, okay, but we don't want to use monetary policy as an instrument for income redistribution, for God's sakes.
Okay.
That's the bottom line. That would be very bad. Now, let's get to your point, though. Your point. You're making an argument. You're trying to be contrary to Hanke, basically.
Okay.
And you're saying, that's what an interviewer is supposed to do. You push back a little bit and get Hanke on the hot seat, and have him squirm a little bit. So here, let's take the Lynn argument. Lynn is saying it's a hypothesis or a conjecture by Lynn. I'm not saying you really actually believe this, but it's a hypothetical. So what happened when the rich got richer? Actually, there was a big wealth effect. this non-neutrality did create a wealth effect. And who the biggest chunk of GDP is accounted for by consumption. About 65%, 66, 67% of GDP is consumption. And by the way, the biggest chunk of that, it isn't the little guy. It's the people with money who consume. The biggest contributors to, in a disproportionate way, to consumption are rich people or richer people. Let's put it that way. Not poor people. Not middle class people. People above middle class. So, in that sense, that did keep GDP moving. No question about it. There was a wealth effect associated with this non-neutral impact of the injection of the money into the system. So that is true, but I don't think that's good. And it's not good because of the negative aspect of income inequality that was created by it, the non-neutral monetary policy. But the Fed didn't even know they were doing this, by the way. That's the addition that Matt Sakurki and I have in that book is to put this front and center on the front burner. This should be an aspect of monetary policy. Stable prices and stable economic growth are also objectives. But this neutrality thing is something new that I think this book adds to the picture.
Well, that's just one aspect of the money system that you've discussed in this very extensive book, Making Money, How to Rewrite the Rules of Our Financial System. Ultimately, then, if you could summarize for us, what is wrong with our financial systems or system, singular, that needs rewriting?
One, people have to stop thinking about interest rates being the monetary policy. Monetary policy, it changes in the money supply. That means the quantity theory of money. So we get the quantity theory of money back in the picture. Now, who produces most of the money? Commercial banks produce about 80% of broad money. So we want commercial banks and the policies that affect commercial banks back in the middle of the picture. And then we also throw in the potential impact that changes in fiscal policy have indirectly on monetary policy. So, and the last thing is this neutrality thing. All those things are new, basically. All those things would change. The quantity theory of money coming in, that changes the fundamental theoretical model used to analyze the thing and think about the thing. And then commercial banks, the importance of commercial banks and their bank regulations and how they affect commercial banks and how that affects the monetary system. That is the second thing. Then the third thing is throwing the fiscal picture, fiscal policy into the picture and how that dovetails and relates to monetary policy. For example, in the COVID period, we had a huge impact in the increase in the fiscal deficit, and 90% of that was actually monetized by the Fed. That's why the money supply grew so fast. So we have that in the picture. And then lastly, we've got this new thing of, you want to have neutral monetary policy. You don't want the kind of non-neutral. You don't want a policy now where the Fed pays no attention to neutrality.
Yes.
Neutrality, it's like the money supply. The money supply is not in the picture now. And neutrality is also not in the picture. We want those things both put in the picture.
By the way, the fact that banks can create money, commercial banks, it may be a revelation to some. I think some people think of banking institutions as a lending and savings institution, but it's not just that. I want to end on this note. If some people have asked this to me and to others, if money can just be created by banks or by the government, why bother saving it? There's just going to be more of it in the system, and my purchasing power is just going to be eroded anyway. Why not just spend it or use it?
Well, you save because when you save, you don't consume. You wait. That's my other book that I wrote with Leland Yeager right before this Sakurki book is called Capital Interest and Waiting. So why do you save? Why do you wait to consume? Because you get paid an interest. That's why you save. If you weren't getting paid interest, you'd consume everything. Or you certainly consume more than if you were getting paid an interest. And you save because that savings gets intermediated and gets into productive projects in the economy through not commercial banks, not deposit-taking banks, but through investment banks. That's the channel the savings goes through. So you save, you wait with the promise that you'll be paid an interest rate, a rate of return. And that savings, most of it gets funneled through investment banks into investable projects, bankable projects.
I think this is
now that's the way savings works. Now the commercial banks are different, as you indicated. They can create money out of thin air, credit out of thin air, and when they do that, that new money that doesn't come from savings, that comes out of the thin air, that goes into bankable projects too. So it's a way to conserve savings in a way. Commercial banks allow us to create money and credit out of thin air, and that means we can get the same amount of investable projects being invested in with actually fewer savings and less waiting.
Well, what if the real interest rate is negative, Professor? At least if that's what I would be getting. Suppose that were the case. What should we do then?
Well, that happened and was happening for a while. It's not happening now. Now the real interest rate actually has gone up to about 1.7% or something like that. And I think it probably will go up to like 2.5% or 3%, something in that zone. Mm-hmm. So you can't run an economy very long if real interest rates are negative. That's an anomalous situation. The equilibrium in the economy dictates that you have to have positive real interest rates. Otherwise, savings and waiting end up withering away. And if they do, of course, you have less finance going into good bankable projects. The economy slows down. Productivity slows down.
Okay, I think there's more to pull out of both books. Let's save that for next time. Where can we study your work in the meantime?
Follow me on X at Steve_Hanke. Right now, I'm running up, 805,000 followers. So there seem to be satisfied customers out there, David. Yes.
All right. Very good. Thank you. We'll be back with Professor Hanke very soon. Professor Hanke and I do a bi-monthly show, so make sure to stay tuned. We'll put the links down below so you can follow Professor Hanke there, and also we'll put his email there if you'd like to write to him directly. Please let us know what you would like us to talk about next time. Thank you very much, Professor Hanke. We'll speak again soon. Take care for now.
Okay, David. Thank you.
Thank you. We'll see you soon. Bye-bye.